to present on my D.Phil research, and that arose from when I was a community protection lawyer at a legal centre in Queensland, Australia, dealing with some of the most poor people in our society, people who for some reason couldn't get access to legal aid, usually because of the forms and the bureaucratic requirements to get to legal aid were too much for them. So we're talking about incredibly disenfranchised people. And these people were struggling with poverty and they needed access to credit on quite a frequent basis. And what I saw was they were entering into incredibly exploitative, short-term, high-interest loans at rates that were phenomenal that some of you will struggle to get your head around. So Wonga, which is one of the world's leading providers of payday loans, before they had an interest rate cap from the government, were giving loans at 5,803% APR. So we're talking about people who borrow 50 quid one week and have to pay back 100 quid the next week. So these loans were getting them into these incredible cycles of poverty, and myself and other policymakers in this area were trying to look at ways to regulate it. But unfortunately, the cutting and making those types of loans illegal created financial exclusion. These people then could not access any form of credit because banks wouldn't lend to them. They were too much of a risk. They weren't going to get credit cards, and their only alternatives were unauthorised overdraft accounts, which could often be even more expensive. So for an example, Lloyds Bank charge £86 per day for people if they go into unauthorised overdraft. So once again, cutting off the access to credit was causing more problems than letting them have these incredibly exploitative loans. So this kind of regulatory quagmire was the reason why I wanted to undertake this research, and I went and did a D.Phil in this topic in Oxford. So first thing I want to talk about is what is high cost credit. Now a lot of people think high cost credit is just payday loans, where you get the loan and you repay it in one lump sum at the when you receive your pay, but it covers a whole range of other products, including pawnbroking, doorstop lending, when the lenders actually come to your doorstop and demand the money from you, and potentially high interest loans in instalments. High cost credit is important because of the impact of the poverty premium. And that's a concept which is quite developed in the UK and Europe, where poor people pay more for the same goods and services, but it's something that Australia hasn't quite recognised, and it means that the regulation in this area is lacking and can sometimes further disadvantage the people who are struggling the most. So credit is one of the areas where the poverty premium makes an impact, because poor people are considered higher risk, thus have higher costs and higher interests when they take loans out. So our research was trying to look at how we regulate this area, and we picked up that historically this issue had not been dealt with particularly well, and we saw this slide between a very freedomist approach, you can access credit in your terms because everyone is rational economic human beings and they know what's best for them, to a sliding to a very protectionist approach saying, no, this type of credit is too harmful, we're going to cut it off and people will have to deal with it elsewhere because that will be in the best interests for them. So freedom is created from this libertarian enlightenment concept where we believe that contractual freedom, the right to enter into contracts of their choosing, is important, and economic freedom, the right to have markets unimpeded by government, is also important. However, protection on the other hand has been, after issues like the Great Depression, is one of the historical aspects where we've said no, the market can work against people, lenders can be exploitative, so we need to protect people, and that usually comes in the form of legislation cutting out certain forms of credit, including high cost and payday loans. So we've seen this ongoing tension throughout history where the government will say freedom is the best approach, we need to let people be rational, they can make their own decisions, and they'll open up the market. And then when that doesn't work because people are being exploited, they then shift to the protectionist approach, where they say, no, we should cut off access to credit for people. Now, I'm saying welfare and poverty and recognition that these people are struggling with underlying poverty issues is actually the conclusion, and we need to add a third basis into this issue, and we need to recognise it from a welfare perspective. So if we recap from now, we have three competing notions when it comes to the regulation of high cost credit. We have the importance of freedom and protection from exploitation, things that have previously been recognised and issues that the government are tackling with. But I'm advocating we need to access provision of welfare. We need to recognise the impact of poverty and respond to it. Unfortunately, there was no research on who was actually accessing these loans. We knew that there was a lot of people accessing them, but we didn't know who and why. And that was quite astounding for me. So when I came over to Oxford, I expected there to be this rich data source, and there wasn't. So I automatically had to switch tunes and do some empirical research to try and recognise the borrowers in this area and what they were doing. So the methodology I used was qualitative empirical research. I actually went and interviewed stakeholders and borrowers in this area and asked them why people were getting into these loans, why people were using high cost credit. And I thought that there was going to be an incredibly complex array of reasons why. But in actual fact, it came down to three very distinct categories of borrowers and 6 specific scenarios as to why people were borrowing, and that was seen across all types of societies, and it was seen across all different nations as well. So the first category of borrowers were class 1s, and these were people who were using this type of credit appropriately and responsibly. So we saw people, if they wanted a holiday that was on sale, or if a big TV came up or something like that, they didn't have the cash in their account, but they knew they could pay it back later. They didn't want to go and wait in line at a bank, so they used credit for the discretionary expenses. Or if there was a car breaking down or one-off expenses they hadn't anticipated. Class 2 borrowers were where people were getting into trouble. It's where people were borrowing to pay rent, to pay bills, to pay everyday expenses. Heartbreakingly, nappies were quite frequent in that list of why people were getting into high cost credit. Or people with existing debt were borrowing to pay off their loans and getting themselves into very nasty debt cycles. Class 3 borrowers were a small but significant minority, and they were people with mental health conditions who were struggling with just day-to-day life. And they were struggling to understand the consequences of debt, so they were getting into it. Or people who had gambling addictions, or potentially in some jurisdictions, other sort of addictions as well, were borrowing to fund those activities. So recapping, we have 3 scenarios, and we have 3 different classes of borrowers, all of which have different needs and value different aspects of loans. People who were using it responsibly, people who were using it because they were desperate, and then people who were using it because of some external factor in their life they were struggling with when they come to making rational decisions. So my response to this was to highlight different classes of people need different issues, and they value different aspects of high cost credit. So class 1, freedom was important. They were using it appropriately. They were choosing to enter into these high cost loans because of the convenience most of the time. Class 2, welfare is incredibly important. They're entering into these loans because they are struggling with life and they're struggling to afford what they need to. And then class 3, protection was important. These loans were harmful and they were decreasing their life quality, and we needed to do something about it. So freedom, how do we regulate to deal with this? The first thing is we need to let people who are using it responsibly and appropriately continue to use it. And we need to let them to have access to these types of loan with certain limitations and restrictions. Secondly, for people who are struggling, particularly people with mental health issues and with gambling concerns, we need to protect them, and we need to cut off this form of credit if there's any sort of evidence that this is why people are using these loans, because protection is the most important thing for them. And thirdly, and most complex response, is recognising poverty, is recognising that these people aren't entering into these loans because they're stupid. They're not entering into loans because they're acting irrationally. It's not their fault. They're entering into these loans because they have no other choice, and because they're desperate and ends don't meet. So recognising the impact of poverty and responding to it. Where to from here? So my research is advocating a legal system which is quite complex, but puts obligations on lenders to recognise the type of borrowers that they're dealing with and then respond appropriately. These are called responsible lending guidelines, and I'm advocating for a poverty premium based response in the Australian legislation. So how do we make politics reflect what's best for us and what's worst? And I'm not indicating this is any sort of reflection on how I feel of our politicians at the moment, but I'm saying that the first thing Australia needs to do is recognise the poverty premium. Something has been done in a number of other countries, but we still have not really understood and tried to respond to it. And we need to regulate in a way that we try and limit and reduce pre-existing disadvantages and poverties as opposed to exacerbating it, which is what the current approach is doing. Thank you.